Greg Andrick here, bringing you another Business Freedom Conversation post. So sorry to be the bearer of bad news, but all of the indicators of a recession, they're here. The yield curve is inverted. What's the yield curve? Well, bonds based on maturity, the curve upward. The longer the maturity, usually the higher interest rate investors want. When investors want a lower yield on long-term bonds than they're doing for short-term bonds, that's called an inverted yield curve. So the yield curve is inverted. It's inverted the deepest since 1981. And guess what? 1981 was when we had the bad economy, high interest rates, and high inflation. The yield curve has predicted every recession since 1969. The Fed is aggressively draining liquidity. Generally speaking, markets go up and so do economies. If liquidity goes up, the money supply, and generally if the money supply retreats, stock markets and economies go down. We're currently 2% decline in the money supply here in 2023, and they're aggressively draining. It's going to be more by the end of the year. Banks are no longer lending. They are retrenching. The Fed has completely crushed credit creation, and that's because of probably the fact that banks are sitting on 2.2 trillion or more of unrealized losses based on the bonds. One or two rate hikes will virtually guarantee a recession. We'll also make sure that the banks are holding even greater unrealized losses, putting further stability into the banking system. There's a 25% potential downside in the stock market based on all of these things occurring right now at the same time. I have a video right after this intro from Yahoo Finance. You're going to see a market strategist from a large fund talking about this, laying all these things out. Take a look at it, figure out how these different pieces affect your business. Get your house in order. Prepare and protect yourself. So this is Greg Andrick, Business Freedom Conversation Post. I'll catch you on the next one.
Economic data today points to a continued pullback in inflation. The Federal Reserve's preferred inflation gauge falling to its lowest point in 2 years last month. Fed Chair Jay Powell, though, making clear this week the central bank is still far from reaching its inflation target. Joining us now is Troy Gajewski, FS Investments Chief Market Strategist. Troy, let's start with some of those comments that we got today, or we got earlier this week, because that comes in light of this economic data that points to further cooling down of prices, at least in core PCE. How should we look at that number when you consider the Fed is insistent on additional rate hikes going into the year end?
Yeah, so look, we've made tremendous progress in a relatively short period of time with regards to inflation, but obviously inflation is still extremely elevated relative to the last 20 to 30 years. And it does somewhat surprise us that the Fed is committed to hiking at least one, maybe two more times at a time where they're draining their balance sheet aggressively, and the Treasury is sucking out hundreds of billions of dollars every several weeks to replenish their checkbook after the debt ceiling limit was launched. So, from our perspective, there's probably only 3 to 5% more upside left in this rally as it runs out of air or support. And there's potentially as much as 20 to even 25% downside from here as the forces of liquidity reassert themselves that did so powerfully last year. The Fed continues to hike. And then just as important, and this dovetails to why is the Fed hiking more when the consumer is starting to run out of gas and you're starting to see the cracks in the labor market, is that the U.S. consumer has been single-handedly keeping the global economy afloat. And fortunately, that's not quite the case anymore. But as soon as the labor market starts to crack, the initial Fed reaction is going to be to high-five one another that inflation truly will go back to 2%. But inevitably after that, we'll have a mild recession, which last we checked is not terribly good for earnings or revenue.
Yeah, Troy, I just want to double check what you said. You said that we could have a 20 to 25% pullback from here?
Oh, certainly. We've always thought that this bear market was not over. We've been surprised, though, to be fair, at the power of this bear market rally. The strongest rallies in markets are always in bear markets. Go back to periods like 2001 or 2008. Ultimately, you run out of liquidity support. And right now, you think of the two clear and present dangers. The first is liquidity is being drained at an aggressive pace. which means it's harder for assets to go up and easier to go down. And then the second, which is really the first time we've dealt with this since the pandemic, is the probability of a recession starting, from our perspective, as soon as Q4 this year, is arguably 70 to 80%. 2022, the economy was not a problem. Coming into this year, the economy was not a problem. It will soon be one of the biggest threats to equity prices and valuations over the next three to 6 months.
Troy, what happens if the Fed does not raise rates? And even at these levels, you're saying that we could still see that big of a pullback?
Yeah, no. So stepping back,
level,
right?
Yeah.
From a risk-taking standpoint, one of the most important metrics to focus on is money supply vis-a-vis nominal GDP. When money supply is growing meaningfully faster, markets tend to appreciate. And after the 42% surge we had in the pandemic, which helped drive that wonderful green light go environment in 2021, the Fed's been draining liquidity aggressively through their balance sheet, and also by flattening and then inverting the yield curve, which has completely crushed credit creation. So even without one or two more hikes, the likelihood for further downside is acute. But one or two more hikes will only reinforce the probability that we're going to have a recession starting as soon as Q4. And by the way, we didn't even talk about bank lending. That's completely stagnated. It's very difficult to grow an economy that's dependent upon credit creation when banks just aren't lending.
So where does that leave you right now? I mean, if we're talking about a recession, a significant pullback going into Q4, where does that put you as an investor?
Yeah, so look, there are so many silver linings of the current environment, right? One is risk-free is a lot higher than any of us ever dreamed of, and you can make a decent return in cash. The second is that there's a variety of alternative strategies that can provide growth, like private equity, middle market secondaries. That opportunity set is booming because there were so many institutions that over allocated to private equity and are now in the process of winding that down, and they have to sell into the secondary market at a significant discount. So that's a wonderful opportunity where you can make above equity-like returns with less volatility and risk, and will have less downside as liquid assets pull back. The second is, if you think about what's going on in the banking industry, right? Banks have started to retrench. They're not going to grow lending at an aggressive pace anytime soon. So it's really the best time we've seen to be a private lender since the global financial crisis. But the key to that, and this is crucial, you have to have dry powder to take advantage of a liquidity vacuum. So whether that's senior secured commercial real estate loans, or that's middle market private equity, or private credit, that looks to be as good as it's been in over a decade. And then lastly, in more liquid strategies, if you don't want to chase NVIDIA at 30 times forward sales, or Apple as it goes from $3 billion to $55 trillion market cap, we've seen a significant slowdown in refinance activity in markets, and this has been driven by much higher interest rates. And so there are cash flows that benefit from slow refi activity. And so that's one of our favorite strategies now in more liquid markets, where you don't have that illiquidity premium like you have in private equity or you have in private credit.
Troy, how should investors be thinking about the allocation of that within alternative investments when they're trying to split up their portfolio? How much of that should be dedicated to some of those ideas that you just ran through?
Yeah, so it's so dependent upon the end investor and what their risk reward objectives are and their liquidity position, their age in life, whether they're a large institution or a smaller investor. But ultimately, when you think about the big picture here, we had excessive asset returns from 09 to 21, driven a large part by multiple expansion and limitless money supply growth. That's not coming back anytime soon. So you should make alternatives a meaningful enough part of your portfolio to help you achieve your wealth goals. So think about high single-digit returns with lower risk. So you have to do enough to move the needle. So you might want to start at 5%, gradually grow that to 10. Obviously, if you're more heavily allocated now, you want to broaden that out from 20 to 30. No one's arguing that the average investor should have over 60%, like many of the large endowments do and have for years and had a lot of success doing so. But ultimately, when you're focused on strategies like this, you end up with less volatility, less knee-jerk reaction, less selling of bottoms and buying of tops, and a smoother, consistent return stream, which helps everyone, whether you're an endowment, a sovereign wealth fund, or an average investor, hit their savings and retirement goals.
So where does that leave you in terms of the equity space? I mean, particularly large cap names. Are you starting to kind of pull back from that?
Well, I'll tell you what we've done in our more liquid multi-strategy solutions is we're trying to take advantage of the last gasp of this bear market by resetting a lot of defensive positions that can provide positive returns if markets do in fact go down as we expect. But, and this is the key but, and this really wasn't available until about 3 weeks ago, because volatility has come down as much as it has. You can put on defensive positions like put spreads or barrier options that don't clobber you if markets keep melting up, but provide attractive upside if markets roll over. So given how narrow this rally's been, given how dominant it has been by mega cap tech, 5-7 names, when markets roll over, it's inevitable that they get hit as well. So we just think the risk reward of chasing this at this stage of the game is not in one's favor if you're focused on consistent positive returns as opposed to, frightening periods of excessive outperformance followed by frightening periods of excessive declines.
Yeah, frightening the word. There feels like on both ends. Troy Gajewski, FS Investments Chief Market Strategist. Good to talk to you on this Friday. Have a good weekend.
Yeah, have a great holiday weekend.